It wasn't supposed to happen. Sydney, the city where property prices only ever seem to climb, is suddenly showing cracks. Buyers are panicking, sellers are confused, and dozens of wealthy suburbs are quietly slipping backwards in value. Mortgage approvals are collapsing, interest rates are squeezing the market, and families are asking the question no one in Australia ever expected to ask. If house prices can fall, what happens next? For decades, Sydney has built a reputation as one of the world's most competitive and resilient property markets, a place where demand always seemed to exceed supply, a city where prices rarely dipped for long, and when they did, the rebound was swift. But in the past year, something extraordinary has happened. Prices in dozens of affluent suburbs have begun to fall, and not by small margins. To the average Sydneysider, the idea seems almost impossible. How can some of the wealthiest and most desirable pockets of the city, places like Kirribilli, Vaucluse, Darling Point, Centennial Park, Earlwood, Beecroft, and McMahon's Point, suddenly lose value? These are suburbs where homes are often spoken of as generational investments. But the numbers tell a sobering story. Unit prices in Kirribilli dropped 17% in just 12 months, and similar declines appeared across multiple blue-chip locations. It has left buyers and sellers in a state of uncertainty. For the first time in years, people are hesitating. Conversations around dinner tables revolve around one question: is it safe to buy right now? Meanwhile, real estate agents who once fielded dozens of offers per weekend now report quieter inspections, nervous bidders, and offers coming in lower than expected. Behind these shifts is a force reshaping the market at every level: interest rates. The Reserve Bank's tightening cycle has rippled through Sydney like a shockwave. Borrowing power is shrinking for millions, and with every rate rise, the ceiling on what buyers can afford drops further. The impact is clearest in high-end suburbs, where buyers rely heavily on large mortgages and price sensitivity is higher than most people assume. Until recently, luxury suburbs felt insulated, a world apart from the fluctuations affecting the outer rings. They were seen as safe havens for wealth, status, and long-term value. But now, even penthouse owners, waterfront investors, and prestige buyers are feeling the pinch. With rising mortgage repayments, higher holding costs, and stricter lending rules, demand is cooling at the top end of the market. Add to this a surge in mortgage applications that aren't being approved, and the picture becomes even clearer. There are buyers who want to enter the market, but can't. Banks are scrutinizing incomes, expenses, and debt levels more harshly than ever. And the $500,000 loan bracket is seeing rejection rates at historic highs. Sydney is experiencing a contradiction: high demand, but low approval rates. It's a bottleneck, a market with its foot on the accelerator and the brake at the same time. And in that tension, prices have begun slipping. For the first time in years, Sydney's property story isn't about runaway growth. It's about a market losing confidence, slowly, quietly, and suburb by suburb. Sydney's prestige suburbs have long been seen as the ultimate fortress of property value. Yet in the past year, a surprising number have recorded sharp declines in both apartments and houses. In Kirribilli, the numbers were startling: a 17% drop in unit prices. The suburb, known for harbour views and luxury apartments, had enjoyed years of extraordinary growth. But rising rates, high holding costs, and reduced buying power have shifted the balance. Buyers who once stretched for waterfront glamour are now recalibrating their budgets. Just down the harbour, Vaucluse, home to millionaires, international investors, and expansive estates, experienced declines in its apartment market as well. The correction in these elite pockets reflects a broader truth. When interest rates rise rapidly, discretionary spending tightens first among buyers who are already pushing their limits. Further inland, Centennial Park, long considered a sanctuary for affluent families and investors, also experienced negative growth. Suburbs such as Darling Point and McMahon's Point, previously among the most tightly held real estate in the country, saw similar patterns. Why these suburbs? Analysts point to several factors. 1. The prestige loan effect. High-income households still borrow, and they often borrow big. Rising rates hit million-dollar mortgages much harder than average loans. 2. Reduced investor appetite. Prestige suburbs rely heavily on investors who assume long-term capital growth. When growth slows or reverses, investor activity drops sharply. 3. Limited transport links. Exclusive suburbs often lack robust public transport. In a high-cost environment, buyers have become more sensitive to logistical drawbacks. 4. Lifestyle adjustments after COVID. Remote work reshaped buyer preferences. Some high-end suburbs that thrived during the pandemic now face softening demand as work-life patterns shift again. But the declines aren't limited to units. House prices are also falling in Kensington, Terry Hills, Little Bay, North Warunga, Avalon Beach, and South Turramurra. These drops underscore that weakening demand is spreading across the city, from beachfront family homes to leafy northern suburbs. Interestingly, the falls are happening even while overall Sydney property values are rising, driven mainly by high demand pockets, limited supply, and returning migration. This unevenness is unusual. Sydney has always been volatile, but the idea of wealthy enclaves underperforming while broader markets rise has led to confusion and anxiety. One thing is clear: the old rule, prestige property never drops, is no longer holding, and that is making many buyers nervous. Interest rates have always influenced the housing market, but the rapid tightening cycle of the past 2 years has fundamentally altered how buyers behave and how much they can afford. Each 0.25% increase in the cash rate reduces borrowing capacity by thousands. For families aiming to borrow $800,000 to $1.5 million, the normal range for many Sydney suburbs, rate hikes can slash budgets by $100,000 or more. Banks are now stress-testing applicants at much higher levels. A borrower who qualified for a $700,000 mortgage 2 years ago may qualify for only $500,000 today. This shift has cascaded through the market. Fewer bidders at auctions, lower maximum bids, cautious lenders, fewer approved mortgages, more price reductions. The transcript mentions something critical: a surge in mortgage applications that aren't converting. There are countless potential buyers: couples preparing documents, families attending open homes, young professionals pre-qualifying. But banks are approving fewer loans than at any point in recent years. This disconnect is driving a sense of panic among prospective buyers. They see prices rising in parts of Sydney. They see supply still low. They hear commentary about market strength. But when they apply for a loan, they hit a wall. Those looking for loans around the $500,000 mark, traditionally the foundation of first home buyer activity, face some of the highest rejection rates. Rising costs of living, credit tightening, and stricter assessments mean that even financially responsible applicants are being turned away. And when fewer buyers are approved, demand weakens in targeted segments, particularly in the mid to high-end suburbs, where prices are sensitive to borrowing capacity. This is the silent, invisible pressure reshaping Sydney's market. Sydney real estate has always been fueled by emotion as much as economics. For years, buyers operated with a sense of urgency: buy now or be priced out forever. But the recent price declines in wealthy suburbs, combined with rising interest rates, have flipped that psychology on its head. Today, the dominant emotions in the market are confusion, hesitation, fear of overpaying, fear of missing out, fear of long-term debt. Buyers are caught between two conflicting narratives. Narrative 1: prices are dropping. Wait for a better deal. Prestige suburbs showing negative growth reinforce this belief. Narrative 2: Sydney always recovers. Buy before prices rise again. Overall market numbers support this. The result? A buyer population stuck in limbo. Not confident enough to buy. Not confident enough to stay out. Economists call this paralysis through uncertainty, and it is creating an unusual market dynamic. Demand exists, but action does not. While Sydney overall is rising, the falling suburbs reveal deeper truths about where the market is headed. They demonstrate the limits of borrowing power, the fragility of prestige demand, the impact of transport, infrastructure, and amenity, shifts in lifestyle preferences, pressure of rising costs. Waterfront units that once commanded premium prices now lingered longer on the market. Family homes in outer pockets face reduced demand. Investors are diversifying outside Sydney entirely. These changes signal a long-term transition, a shift from a market driven purely by scarcity to one influenced by borrowing constraints, lifestyle shifts, and demographic change. Sydney's housing market now stands at a crossroads. Will the declines in wealthy suburbs spread? Will mortgage rejections grow worse? Will interest rates loosen or tighten further? Experts predict some prestige suburbs will continue to fall. Middle-ring suburbs may rise the fastest. Buyers will remain cautious. Mortgage approvals will stay tight. Supply shortages will prevent a major crash. Sydney may not be headed for disaster, but it is headed for transformation. The era of unstoppable price growth is over, and the era of unpredictable volatility has begun. For families, investors, first home buyers, and downsizers, the message is clear. The old rules no longer apply. The suburbs once seen as invincible are showing cracks. The market is shifting, quickly and quietly. And for the first time in years, nobody is quite sure what will happen next.